This ETF is supercharging my portfolio, and it may be something you've never even heard of. Many investors, possibly even including yourself, have been sleeping on this ETF and are missing out on the massive gains and appreciation. But hopefully, after today's video, you might be ready to add this beast to your account. The ETF I'm going to discuss today is none other than the Invesco S&P 500 Momentum ETF, SPMO. Now, this isn't some fly-by-night ETF, brand new in the marketplace, everyone's talking about it. This has actually been around since 2015, so there's 10 years of market data to back it up. You won't believe the annual returns on this behemoth. 18.5% average over the last 10 years. Some years, way more than that. Stick around to the end of this video and we'll do a calculation of how much you'll earn for retirement if you started an investment today of $25,000. But before we get started, welcome back to the channel where we discussed how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money in the markets. What we discuss here may work for my portfolio, but it might not work for yours. So let's get started. The Invesco S&P 500 Momentum ETF is exactly what it sounds like. It's all about the momentum of the market and the top leading companies in the S&P 500. Let's take a look at the prospectus and find out exactly what this ETF is all about. Strictly in accordance with its guidelines and mandated procedures, S&P Dow Jones Indices compiles, maintains, and calculates the underlying index, which is designed to measure the performance of approximately 100 stocks in the S&P 500 index that have the highest momentum score. In general, momentum is the tendency of an investment to exhibit persistence in its relative performance. A momentum style of investing emphasizes investing in securities that have had better recent performance compared to other securities. The momentum score for each security included in the underlying index is based on price movements and volatility of the security as compared to other eligible securities within the S&P 500 index. Selecting constituent securities for the underlying index, the index provider first calculates the momentum score of each stock in the S&P 500 index by evaluating the percentage change in the stock's price over the last 12 months. The index provider then selects approximately 100 stocks with the highest momentum score for inclusion in the underlying index. Pretty straightforward, right? Basically using this information to figure out which are the top 100 stocks that they can use in this fund. Here we see Nvidia, Meta, Amazon, Broadcom, Tesla, JP Morgan, Walmart, Palantir, Netflix, and Costco. These make up the top 10 of the ETF. Looking at these, this is a big reason why when we look at a chart of SPMO, you can see that there is a clear uptrend, especially over the last few years. These stocks individually have performed very well. However, when we break down the overall mix of SPMO, you can see here that the fund is fairly diversified, albeit it is still fairly tech heavy with roughly 34% in information technology, but there is still a pretty heavy concentration in other industries that keep it a little bit more grounded, with almost 20% in financials, 16% in communication, and 10% in industrials. Regardless, this ETF packs a powerful punch. Currently, year-to-date, according to Yahoo Finance, SPMO has an annual return of 28.6%. Here you can see a one-year return of 34.7% and a three-year return of 35.41%. This shows extremely aggressive growth. But then why don't we compare it to something that we all have in our portfolios, some version of the S&P 500. For the sake of today's video, we'll use SPY, but I personally own VOO. Let's compare the year-to-date for SPY versus SPMO. As you can see, the return for SPY on the year is 13.78%, where SPMO is over 28%. For investors like you and me, that's a substantial difference. But what happens when the market pulls back? What happens in down years? Here we can see the two main red years side by side when major pullbacks occurred in the market. For SPMO, we have a negative 0.9% compared to the SPY's negative 4.5%, which is 5 times the pullback for 2018. Jump ahead to 2022, and you have a negative 10.46% for SPMO compared to a negative 18% for SPY. Pretty substantial that SPMO was able to mitigate any of the major pullbacks compared to the overall market. The percentage gains on the upside are that much better, but the pullbacks and the percentage downturns aren't as bad. So the higher highs are great and the higher lows are even better. So we just compared SPMO to SPY, and I think it's very important to include QQQ in this conversation, as I'm sure many of us hold QQQ or QQQM in our portfolios. And if you don't hold either one of those, drop me a comment below and let me know why not. Let's take a look at SPMO side by side with QQQ and compare the appreciation and downside. As the markets trend and run higher, QQQ is always going to be a beast. It has massive gains, upwards of 54% annual return. But when the market goes south, so does the ETF. QQQ is obviously going to have much greater appreciation because it's far more heavily focused on tech. And with the massive AI run we're on right now, you're going to see far more volatility. However, because of that volatility and a heavy interest in tech, you're susceptible to massive crashes and pullbacks, wiping away all those hard-earned gains. One of the things that I really like about SPMO is that it has massive upside appreciation, but when the market pulls back, historically, there's been very conservative downside. So let's compare all three side by side, SPMO, QQQ, and SPY. Take a look at the charting data on Seeking Alpha for the last 5 years and really understand how well this performs. Looking at this chart, the appreciation has been that much greater over the past couple of years, so the lows were actually higher lows in comparison. A good reason for this is that the fund is very diversified in different ways than the other ETFs and is actively rebalanced twice a year. So if part of the year the top leaders are lagging, they will eventually be replaced by new leaders, taking advantage of new trends in the market cycle. Now, if you're like me and you live a very busy lifestyle, kids, work, gym, wife, the whole 9 yards, you really don't have time to analyze every little aspect of the fund. So this brings me to the next part. What is the cost of owning this? Expenses are always a concern for investors, especially with actively managed funds. So surprisingly, the expense ratio for SPMO is incredibly low. With such a great makeup and a solid return, with the amount of growth this ETF has shown, you would think it would be far more expensive than just 0.13%. Now let's compare it to QQQ at 0.20% and SPY at 0.09%. They're all relatively close with each other, all in the ballpark, but for the amount of gains and appreciation that SPMO offers, I think it's a relatively inexpensive and cheap fee. Now with the historical growth of SPMO over the last 10 years and an average of over 18% annual return, I've definitely toyed around with selling some of my ETFs such as VU, putting those proceeds all into SPMO. It's a very attractive thought, especially given all the appreciation in recent years. But at the end of the day, the S&P 500 has been around for 68 years. There's 68 years of market data, tried and true, to go off of. Let's take a look at the prospectus again and what Invesco has to say about momentum style investing. The momentum style of investing is subject to the risk that the securities may be more volatile than the market as a whole, or that the returns on securities that previously have exhibited price momentum are less than the returns on other styles of investing. Momentum can turn quickly, and stocks that previously have exhibited high momentum may not experience continued positive momentum. In addition, there may be periods when the momentum style of investing is out of favor and therefore the investment performance of the fund may suffer. S&P 500 has a lot less volatility and therefore less risk compared to SPMO. That's exactly the reason why I'm holding on to my VU for the foreseeable future. There's much more stability over the long run holding the S&P 500 than there is so far in SPMO. I've got 25 years to retirement, so I definitely want to have one aspect of my portfolio that is slow and steady. Just remember that with volatility upside, there's also volatility downside. The stock market can drop on a dime, where previous stocks that were having the highest of highs all of a sudden out of nowhere have the lowest of lows. Think 2020 and the COVID crash. There's also lulls in market cycles where momentum slows, so the fund may experience slow growth periods and can't be restructured until every 6 months. I personally have been adding SPMO to both of my brokerage accounts, which have seen a massive boost in appreciation. To me, I consider SPMO a blended ETF because the pullbacks compared to the SPY have been very conservative, but the massive appreciation is more on par with something like QQQ. I personally add SPMO to one of my brokerage accounts that has QQQM in it and another one that has SCHG. I really don't anticipate these not continuing their massive growth cycles over the long haul, especially with rate cuts looming and currently this AI and quantum computing still in the infant stages. Considering SPMO is actively managed, I have no doubt SPMO will continue to grow for the long term. Yes, we will have pullbacks, but we'll also have growth that will continue in the long term. The lower volatility aspects of SPMO and VOO will make sure to keep a foundational base, while the heavy growth ETFs of QQQM or SCHG give me that extra push on the upside trends. Now, before I leave you, I promised at the beginning of the video that I would show if you invested $25,000 into SPMO, how much money you would have for retirement in 30 years. So here you can see $25,000 investment for 30 years. I used an estimated rate of return of 18.52% because that is the average 10-year return up until this time. As you can see, with no additional investments into this fund, $4,089,679. Now let's take a look and see if you were to invest just $100 a month, how much more would you have? Your new balance would be $5,229,841 over the course of 30 years, and your total investment would be $61,000. Just remember that previous price history does not guarantee future results. Obviously, we can't expect the average annual return to remain at an 18.5% over the next 30 years. This is just for theoretical purposes, but you get the idea of how powerful an ETF like this could potentially be. And while I continue to add this momentum ETF to my portfolios, I still continue to dollar cost average into high yield dividend income ETFs. If you want to learn what a great income ETF that you can add to your portfolio and complement it with SPMO, check out this video right here. Make sure to check out the blog at portfoliopayday.com or check out the links below for all my other investing videos. Until the next time, have a great one.